Hey, this is Kyrill Asatur with Centerfin Capital, and this is collective for the week ending April 5th, 2024. We like to highlight a handful of things that we thought were interesting during the week and bring it to your attention. We'll discuss the spike in the price of oil, which we think is happening because of heightened geopolitical tensions in the Middle East. Secondly, we'll discuss the latest social media chart, which Bank of America put together, which shows the interest that the U.S. government will owe at the end of this year, which is $1.6 trillion. And then we'll discuss the jobs report, which came out on Friday morning, which was much stronger than expected, and the market reaction to that. Starting with the price of oil. So Brent crude, which is really the benchmark for about 70% of the oil market, spiked to over $90 for the first time since last fall. If you recall, the price of oil spiked to $120 during the post-COVID recovery period. And then Biden released the SPR, which is the Strategic Petroleum Reserve, in order to lighten the price of oil. That brought the price of oil down into the 70s, which is much more manageable, and that helped with the inflation picture at the time. But now it's back up above $90. This week, Israel bombed a Iranian embassy in Turkey, which is really almost an attack directly on their soil. And Iran responded by saying that they will get revenge. That could mean a lot of different things. I think it put the world into a heightened geopolitical situation because Iran can easily influence the price of oil by upping their attacks on various shipping vessels throughout the Middle East region. It's definitely a geopolitical premium in the price of oil. The price of oil is very important because basically the whole world runs on hydrocarbons today. Whether we like it or not, that's still the case. We see it directly at the pump, as they say, when we go fill up our cars with gasoline. We see it in the price of gas. As the price of oil goes up, that directly responds with a spike in the price of gas. If oil prices stay elevated for longer periods of time, it's actually worse for pretty much everything. Because if you think about it, everything that you buy at the grocery store gets delivered by a truck, which runs on diesel. When you travel, that airplane runs on jet fuel. If the price of oil stays elevated for an extended period of time, that feeds through to inflation across pretty much every part of the economy. While directly people feel it at the pump, and it's really felt by the lower income population more than anything else, in an election year, obviously Biden does not want to risk higher oil prices and higher gas prices at the pump. This is a problem. What did Biden do? He basically stopped the refilling of the SPR. The SPR is basically a reserve of oil that the U.S. government controls, where when the price of oil is low, they will fill it up. And then in order to decrease the price of oil when it spikes, they will release oil from the SPR in order to affect the price downwards. Biden announced this week that they would stop refilling the SPR, and that should take some pressure off of prices. We think at the end of the day, this just comes down to geopolitical risk. And as we've discussed for many years, geopolitical risk is always present, but it happens to be we're living in a time where we have two live wars going on, one in the Middle East, one in Russia and Ukraine. We have tension in China with Taiwan. We just seem to be living in a heightened geopolitical tension environment, and that is not great for inflation. We'll see how things shake out with this latest attack and if that really escalates the situation or not. It's definitely not good for markets in general because it creates uncertainty. The chart, which Bank of America put out, showing where U.S. government debt service, the interest payments that the U.S. government will owe on U.S. treasuries at the end of this year will spike to about $1.6 trillion if nothing happens to interest rates. If the Fed were to lower interest rates, if they did the 3 cuts that were expected, it would still be about $1.2 trillion. To put that into perspective, the whole U.S. budget for this year that Biden just announced for 2024 is $6.8 trillion. $1.6 trillion is close to 25% of the U.S. budget. The next biggest expense, which historically has been our biggest expense as a percentage of the budget and as a percentage of GDP, is defense. And defense is just shy of $900 billion. If nothing changes, we're going to be spending $1.6 trillion this year on interest expense on our debt, which is about 25% of the budget for the whole year. We are running a massive fiscal deficit. I think the fiscal deficit is something like 6 or 7% of GDP. That amounts to, again, it's roughly $1.6 trillion for this year. It's supposed to spike to $1.8 trillion in 2025. And these are government figures. These could be way off and it could be way worse. Now, why is that a big deal? When a country spends more money than it makes, the deficit simply speaking, is your tax revenues that you get from taxes, so people and corporations paying their taxes, minus your expenditures, which is the budget. When you're running a deficit, that means you're spending more than you take in taxes. Historically, that's really only been allowed during wartime. It's conceivable that you would have to spend a lot more money than you usually would, and so you would run a deficit. We've been running a deficit for quite some time, and that's very negative generally for the currency of the country, for the US dollar in our particular instance. If the US dollar were to come under pressure, that's generally negative for inflation in the country. It all comes back to inflation, and bad fiscal situation is bad for the currency, it's bad for inflation, it's bad for its people. Unfortunately, lots of people are focused on the election at the end of this year, but if you talk to the people in the know, not a lot of things are going to change. Whether Biden or Trump gets elected into the White House for the next 4 years, neither one of them are going to do anything about this deficit because it would entail raising taxes and cutting spending. Neither one of those things are feasible in either administration. Unfortunately, we're on this trajectory where we are running bigger and bigger deficits. That's not going to be good for our currency. It's not going to be good for rates. It's not going to be good for inflation. Take a look at the chart. It's obviously concerning. And if nothing changes, it's just going to continue to go in a negative way. Last but not least, on Friday morning, we saw the jobs number came out about 303,000, way higher than expectations of 214,000. It was actually relative to history pre-COVID, only 15% of the time the number was above 300,000. It's pretty rare to have this many jobs created in 1 month. It was an outlier. It was more than expected. The unemployment rate stayed at about 3.8%. Wage growth was above 4% still, but showed a little bit of signs of declining. The only caveat is that a lot of the hiring seemed to be part-time workers. There was actually a loss of full-time jobs, but a lot of part-time hiring. Regardless of whether or not it was part-time or full-time jobs, it just shows the strength of the economy, and it's going to make it very difficult for the Federal Reserve to lower interest rates. Now, the futures haven't changed that much. I think the odds are still pretty good that there's a cut at the June meeting. The market is still pricing in about 2 to 3 cuts this year. The long end of the bond market, the 10-year and the 30-year spiked on that news. The last time the 10 years trading spiked above 4.4% on the news. The last time the long end of the bond market traded this high was in the fall of last year, and that was really negative for risk assets. So stocks sold off pretty significantly when the 10-year reached 5%. It was September of last year. Obviously, the economy is strong. If the Fed is not able to cut rates because of the economy, then higher for longer, which is a scenario we've discussed many times in the past, is more likely. That could be negative for stocks. That's it for this week. As always, let us know, reach out if you'd like to discuss any of this in more detail. Drop comments as it relates to the current macroeconomic environment, company-specific things. Happy to do that in our next session. Take care. Have a good weekend.